So now I'm going to go into uh, volatility. This is more on just general trading. So in previous video, I covered Robinhood, a little bit on how to create a Robinhood account. What is a put option? What is a call option? Why do you want to do individual stocks as opposed to indexes? Or what type of indexes do you want to buy if you want to do an index? And then I covered like a little bit on how to make money on a stock like Tesla that's already calling it overvalued. I don't agree with that, but saying that Tesla will go up by another 100% or 400% this year, I don't think so. I don't think it'll go up by 400%. I feel confident saying that. It's already got up 1,000% roughly over the last year. So there you are. So I covered a little bit of that. Now let's talk about profitability and volatility trading. So a lot of your money is made from when it comes to investing, a lot of your money is made from highly volatile assets. If something is predictable, if something is consistent with the past, then you're not going to be able to make that much money from it in a normal sense. There's value investing, which I'll go over next, but you can make a lot of money with value investing, but it takes multiple years to be a good value investor and holding a cash position for a very long period of time. You might have 50% cash as a position for a decade, for 5 years. With the last boom bust cycle, if you were successful and you put all your money in immediately after Corona, right at the dip time when the Dow went down about 30%, but I think it might be at like new all-time highs already. But that's basically, when people think value investing, they often look at value investing on individual stocks, which I will say I really question that use of time. But if you think of value investing as waiting for the next Corona, waiting for the next big war to come up, waiting for the next big corruption to fall, like let's just call it every 5 to 10 years, is what the basic expectation is, that there will be some crash every 5 to 10 years. And if there's not a crash every 5 to 10 years, then that sets things off. If the stock market becomes so predictable that you know that there will never be a crash again or never be a significant crash, then you can justify over leveraging yourself into the market, which gets things weighted weighted in one direction, and then profitability becomes a little bit more challenging. So it's healthy for a market to have a crash every 5 to 10 years. And then if you're a value investor, then rather than looking at individual stocks, I would recommend waiting for an overall market crash, such as the Corona. And then you just pick things at random, or the blue chips. You just pick the Facebooks, the Amazons, whatever. But anything that's crashed during the Corona, if you were mostly a cash position, or 50% roughly is what I might recommend someone being, like 50% cash position, boom, you pop all your cash in right then and there after the Dow or the S&P takes a 30% hit. That's pretty much what you have to be very mechanical and just say 25% hit on the S&P, the Dow, I'm going to put all my money in. Same, that's the type of mentality you have to have. Or you say maybe 40%, but the S&P and Dow didn't go down by 40%. So maybe it will next year, but now you might have to wait another 10 years while your position is largely cash, a huge portion of your investment is cash. So that's basic value investing. And if you did the value investing where you set your threshold at 25% a dip in the S&P and the Dow, and you did have a 50% cash position, and you held that position from 2008, when the housing bubble occurred, 2001, the stock bubble occurred, but 2008 to 2020, a 12-year period, you held that 50% cash position for 12 years. You threw it all in right when Corona max dip, 25% decline in the S&P, etc. You threw it all in. You would have had about 100% returns in roughly 6 months, and you'd be cashing out already. So that's a basic form of value investing, which is the idea of picking something that is down for a liquidity reason as opposed to down for a underlying asset reason, like Amazon. I don't even know if it went down from Corona, but Amazon might have gone down from Corona, and that's clearly a liquidity cause as opposed to Corona affecting the business of Amazon. I mean, a little bit, but Corona is going to affect the business of selling things in person, like maybe, I don't know, stereo equipment or something, but it's not going to affect online businesses for the most part. It really helps them substantially with all the shutdowns and things. So, but that's volatility investing, which is a multi-year process. I kind of went backwards on my explanations, but our value investing. Value investing, which is a multi-year process, and you're waiting for a liquidity crunch. You're waiting for a bankruptcy type scenario, not because the assets have changed, but because the world did something funny. Another one people talk about is Chipotle, and there was like some kind of a salad scare or whatever, and whatever. But the waiting for a market crunch, like buying real estate stocks right during the real estate crash or whatever, buying oil when oil went to negative $10, buying tech stocks right after the tech bubble bust or whatever. That's a lot simpler and a lot more basic form of value investing. And just sticking with the topic of Tesla, where if Tesla goes down, it's been at $500 after the stock split and all that. If Tesla goes down to $250 or something, you might think of yourself as a value investor at that point. Tesla is currently at 420, it was at 500, and someone could call themselves a value investor, which I'd fully disagree with, but they could call themselves a value investor with the claim that Tesla is worth $2,000, going to be worth $2,000. I might not disagree with that statement. I might not disagree that Tesla will be worth $2,000, a couple of years, 3 years from now, maybe something like that, maybe next year, whatever. I might not disagree with that, and therefore they could say, oh, I'm getting a value, I'm a value investor. Well, you're not. It's not what the term is used to indicate. That's a growth investor, because you're predicting Tesla will do things that it's never done before, which what Elon is trying to do is create a battery company, a company that where 75% of the sales are in battery and solar, and maybe 30% cars, whereas currently it's like 80% cars, 20% solar, and everything else, batteries. So, but that's growth. That's growth investing, and I definitely recommend growth investing. But just the difference between value is taking something that was worth a lot of money and is currently at like 50% the value of what it was previously, and then growth investing is saying that a company will achieve something that it's never done before. So Elon is making Tesla a growth company, and that is the way I like to invest. I like to invest in growth companies. I think you have more upward potential with those But value investing is a relatively safe way to invest, and the only downside is you have to hold cash. You have to hold cash for 5+ years. So if you're a young person, it can be quite hard to hold your money that long. If you're an older person, like 60 plus, then value investing is awesome because you might want to be in a largely cash position because that's how you're spending your money. So you might want to be in a largely cash position. You wait for the stock market to tank, you pop all your money in, boom, you make a lot of money real quick. So that's basic value investing. And next I'll go over volatility trading, so and growth and stuff like that. So, I'll just go. I'll just keep going. So volatility trading and growth investing. But volatility trading is where you'll make a lot of your money in the market. And if I was to say some generic percent, I like the idea of doing 50% in roughly a value investing type of mentality, 25% into a growth stock mentality, and another 25% in a volatility type of trading mentality. Volatility referring to short term, like monthly, and growth being 2 to 3 years, and value investing being like every 5 years to 10 years for that. That's the frequency of how often you trade. So, so going into volatility, why do you want to invest into volatile stocks? Why do you want to do that? Like, let's say Bitcoin is an example. Bitcoin going up and down, up and down. Why do you want to invest into Bitcoin? And how do you invest into Bitcoin? Well, okay, yeah. I'll go ahead. I'll cut it off here and then I'll get into the next video. So if you like that, Patreon below, join Bitcoin 1776 newsletter. We'll be giving away some prizes and you can mine coins. It's a little project I'm working on. Your support much appreciated. So thank you very much. Keller Burnett, CPA. So all right, so let's go into volatility trading. So Bitcoin going up and down, and you might ask yourself, why would you ever want Bitcoins? If you know that they could go down or they could go up, who knows which way it's gonna go, so why do I want it? Well, now there's some people in the Bitcoin communities who go a little bit obsessive on Bitcoin, and they say that you need to measure your wealth in Bitcoin and all this other kind of behavior. And that's fine. That's a different type of thing. Now, granted, I'm a big Bitcoin supporter. I think you're aware of that. My name, Bitcoin 1776. Big Bitcoin supporter, but here I'm just talking about making money with Bitcoin. So you know the thing's volatile. You know that in Bitcoin land, going up and down 10 to 20% a month, kind of like Tesla stock, is really quite a normal thing for Bitcoin to do. Now, I personally think that Bitcoin's quite undervalued at $10,000. At 15,000 is for the 2021 year, is 15,000 is about where I'm going to call it. Where I'll stop encouraging people from buying Bitcoin, but I'm definitely going to encourage you to buy Bitcoin at 10K. Yeah, but regardless. So if your only objective is to make money, then if you get into a situation where you buy Bitcoin at $10,000, you sell it at $11,000, 10% up, you make $1,000 profit, 10% profit in this situation, and you never buy Bitcoin again. It goes up and up forever. Who cares? You made 10%. 10% is a phenomenal return, and you might have made that quite quickly. You can also, let's say in another scenario, Bitcoin is at 10,000. You buy it at $10,000, and 5 years from now, it has never crushed the threshold of 10,000. And let's just say it's, you break even 5 years from now. Well, there you go. That happens, or it goes down forever. Never. You happen to have bought it at the top. That could happen, right? So you want to be a little bit careful when you do volatility trading. You don't want to buy just buy something with the assumption it will always go up. That's a little bit that's like the moon boys, people call that, or the hugely the fanboys, the crazy, I'll keep Tesla at any price. I'll never sell any amount of my shares. I'll never sell Bitcoin at any price. Those people are more hype. And the people who will say, like, Tesla's at $400. Some people will tell you Tesla's going to go to $4,000 any minute now. And that's a little bit of salesmanship. I don't think that's realistic. And the Bitcoin people who say Bitcoin's at 10,000, it's going to go to 100,000. I think, again, that's a salesmanship, unloading their bags, as people say. But a simple type of volatility trading is you just you buy whatever it is. You have no real desire to hold a position in the asset. You're not really trying to hold a position in the Tesla or the Bitcoin asset primarily, but you buy Bitcoin at $10,000. You sell it at 11,000. You make 10%. You go back to cash. You're good to go. Or if you want to go a little further with that, you can have a mindset of, I'm going to buy it at 10,000, sell it every time it goes down to 11, and then I'm going to use all of that money and rebuy at 10. And I'm just going to constantly cycle this process. If it keeps bouncing between 10 and 11, 10 and 11, 10 and 11, then I'm going to constantly buy more and more and sell at 11 and get a bigger and bigger profit. So there's a lot of things that go in a sideways fashion for an extended period of time. I am kind of the position that I think Bitcoin will go in a sideways / up fashion, like from 10,000 to 15,000 over the next 18 months. That's loosely my position with Bitcoin. And Tesla, I think, will go in a very sideways fashion for probably for another 18 months. I think Tesla will go in a similar sideways fashion. I don't mind owning big positions of either Tesla or Bitcoin long term. But when it comes to profiting, instead of buying Bitcoin and holding, buying Tesla and holding, I'm going to buy some amount, sell it if it goes up 10%, and then buy more at the original base price that I'm shooting for. And if you're patient, if you have no desire whether or not you own Bitcoins in the future or you own Tesla shares in the future, if you're only doing it for money purposes, which is generically what I'll recommend, then volatility trading can make you a whole lot of money with simple rules. You don't have to watch the stock. You immediately, you buy it for 10,000, you immediately put in a limit order, they call it. Ooh, I didn't even go over limit orders. You put over a limit order that you'll automatically sell if it goes to 11,000, and you have that order. They're usually good for 3 months. You have that order just sit there forever, and you really have to never pay attention to it. And then if it sells, you just have to rebuy and you're good to go. So I might recommend doing 25% of a portfolio that way, 25% in growth, and 50% in value investing, which is primarily just cash and waiting for the every 10-year collapse of the economy. I think that's pretty much a good investment philosophy. And I'll go into a little bit more about investment philosophy and some other topics I might have not covered in the next segment. But if you like that, join the Patreon and join Bitcoin1776.org. That's a organization that we're giving away some money, a newsletter, prizes, getting people to talk about investing and life and so forth. Feel free to do that. Okay, thank you very much. Now on to some general topics that I sort of glossed over or didn't cover when it comes to investing in stock things.